N Jayakumar, Managing Director with Prime Securities. Akha Jakes joins us. Jakes, good morning. Thank you for joining us. Will it be a good morning for India, considering that the tariffs have been rolled out and tariffs are certainly higher for countries like China, Korea, and even Vietnam?
I think on a relative scale, we can say that we've come away relatively unscathed compared to what could have been. But I think, frankly, if you look at it, there is no sense in what has happened. I think dramatically increasing tariffs across the board are, at best can be disruptive. At worst, it can be a lot worse. So the way I would look at it is that, this is not a good development. And if you go back and even check two basic things, how do these rates even come through? They talked about tariffs, tariff rates plus non-tariff barriers, etc. Quite honestly, very simply put, if India has, let's say, $80 billion of exports to the US and runs a 41 billion trade surplus, then 41 divided by 80 is taken as the rate and divided by 2 is the sort of number that he has given you. This could have been done on day one. Why did it have to be done after so many days with so much song and dance? I think basically, if you ask me, this is a political message. This is a negotiating tactic still. And the window between now and the 9th. So first of all, if you are convinced that there is no logic to these numbers, then what India has done in the interim in terms of discussions of what Vietnam has done in terms of dropping tariffs, all this has not been taken into account. Between now and the 9th, those negotiations will happen. At the end of the day, he's a deal maker. He's a negotiator. And that's the way he's conducted life. He's conducted business in that way. Everything for him is a deal. Everything is a conversation with a friend or a foe. And for the sake of a deal, anything will go. So these are just numbers, capped numbers for the moment. These rates will come down. But to the extent that specific sectors have been exempted, it clearly shows the shortages that exist in those products, in those sectors. Whether it's pharmaceuticals or minerals or any of these, the US is in serious short supply. And there could be a lot more damaging impact it could have done had tariffs been imposed on these. At the very least, it could have been disruptive, already is, by the way, for the average US consumer. And it could have been a lot more. There could have been, I hate to say it, but there could be street uprisings on this kind of tariff increases. So given everything, he's been a businessman to the extent that he's carved out a certain few products. But most importantly, and these are products which low-cost producing countries are supplying to the US. There's no real reason to put tariffs on these unless the only objective is to hurt the US American. And if you see the rates that have been calculated, these are just numbers that have been thrown at you, knowing that these numbers will come down. So at one level, the illogical approach to these numbers, the lack of any scientific basis to these numbers, and the fact that these numbers could have been given on day one means that there is actually, pardon my saying so, but nonsense, nothing has happened. It's nonsensical work that has been done to arrive at this. This could have been done on day one. So it's just another salvo being fired through an executive order to say that these are the tariffs that are imposed, but I'm giving you a window because I'm always ready for a deal. Big deal.
Sure. Jakes, I think what it's done is at least given us a ceiling of how bad can it get.
Sure.
Yes, there are going to be negotiations and, there could be chances of rollbacks as well. Who knows with Trump how it's all going to play out. In the interim though, Jakes, tell me, what does it mean for a market like US, wherein the valuations are sitting at all-time peaks? You have seen some of the tech cos, correcting, but it's not been broad-based. And what it means for the US dollar?
I think the US dollar goes down a lot more in the short run. I've been maintaining that this is not about tariffs. This is about a buildup of a serious trust deficit around the US and its policy making. The fact that they can act as big bullies, do things which are seemingly illogical, go all the way to say, I don't really care what happens to prices in the short run in terms of auto, etc., and yet go through with this all with a view to negotiate, clearly shows that the trust deficit and the lack of US as a credible partner, at least for the medium run, while the current dispensation is around, that has been clearly established. Number one, the US markets are the consumption capital of the world. What do they export? They export services, whether financial services, whether they export entertainment-related services, or they export software services. That is the crux of the US market. What if suddenly countries were to start imposing tariffs on that kind of stuff? It would hurt them every which way. So I think the US markets, to my mind, have run into real rough weather. The US markets, as in the US dollar, for instance, will, I think, sharply decline. 110 came down to 103 on the dollar index, has broken that this morning, it's gone below that. And I wouldn't be surprised if it broke 100 and towards the rest of the year, as one of the few things that has not changed is the US competitiveness was never there on manufacturing. No country in the world has moved from services to go back into manufacturing. So you try to turn the clock in order to get something out. Then you go back and say, so many countries have actually reduced rates in the 1 week. It's a clear win for all of us. Actually speaking, you can't just increase tariffs and expect demand and supply not to get disrupted. So keeping in mind that economics is being sought to be redefined and relearned out here, leaving all that out, money that had moved to the US markets, and that's important from our markets perspective, money that had moved to the US markets post the Trump elections, that started moving out already. It's going into other markets, whether it's going into emerging markets or it's going into Europe, for instance. And Europe has got its own issues, but they're coming together based on these Trump threats. I think India will be a big beneficiary of money coming back into these markets. And in that, the sectors like pharmaceuticals and to that extent, even IT services will actually stand out as sectors that will be even more relevant, especially in the context of exports, where you're more competitive vis-a-vis a lot of the other countries and other competitors.
So, Jakes, let's look at specifics for Indian companies now. Ultimately, what markets would look out for is earnings. So, can I say that barring, let's say, auto components, few companies here and there, the aggregate picture for earnings, which was under threat because of tariff rollout, that does not change. And there will be no material impact in FY26 and FY27 estimates because of tariffs?
Well, you should be worried about the fact that the consumption capital of the world is now being beset with tariffs. And to that extent, if the US consumer is hurt because he's paying a lot higher and he's paying a lot more while competitiveness in terms of employment, etc., is not coming through, then I feel that you could, in non-critical areas, which means discretionary, you could, for instance, on gems and jewelry, argue that consumption expenditure in the US will fall. But for absolutely basic essentials like pharmaceuticals, I think the pitch is quite clear. For IT services, there is another headwind, which is AI and the sort of low-cost AI that China seems to have come out with. So given that, I think there are some headwinds that have emerged, not necessarily because of tariffs, but tariffs alone may actually help to actually curtail discretionary spending in the US, especially for products that are imported into the US. So from a markets perspective, we've got our work cut out. China is reflating, Europe is reflating. Trump is keen to get, at least he says that he's keen to get manufacturing back. So one of the things that will happen is the Indian liquidity position, courtesy a proactive RBI, which in the last few months has done an amazing job in terms of, preemptively increasing liquidity. So with the RBI increasing liquidity, certain easing of rules in terms of conducting business in the banking space, I think that the banking sector will lead a stock market rally and essentially be the tool around which they are hoping to get more private sector capex in, along with the public sector capex. So we have to go back to the capex cycle in domestic manufacturing. We have some competitiveness on the export front now with this, though these numbers will change. And if liquidity conditions continue to ease the way they are, and competitive pressures from China, Europe, etc., is to reflate the economy, and the Indian economy also gets monetary or fiscal stimuli to that extent, I think the markets have found a bottom, and I wouldn't be surprised the market went up a lot higher with foreign money coming through and SIPs resuming.
Sure. Jakes, other than, auto components, which I guess is going to be the hit sector, other than that, do you think the big loss is going to eventually come in from US discretionary spend, which may actually slow down? And that's where I guess IT gets a little bit into jeopardy.
IT's got two headwinds. One is discretionary spending, both corporates as well as individuals. So that's not so much an individual issue. But I think the AI impact is still playing out. And I think how, on almost a daily basis, we're getting versions of LLMs which are making life easier for us as in whether it's financial markets or it's, the legal profession or it's the medical profession. So I personally believe that the impact of AI is still playing out. It's early days, and the impact is pretty dramatic when it's getting revealed. And to the extent that China has revealed that you don't need to spend, the sort of hundreds of billions of dollars to be able to generate absolute cutting edge large language models and variants thereof and agents, etc. I think to that extent, the world will get to see, sort of the low cost product as well, whether it's DeepSeek or, any variant thereof. So I think the IT, the coding being affected, the standard services being affected, I think is a given. We just don't know how much it is. Maybe current contracts are playing out. Maybe new contracts will not get rolled out with the same speed and efficiency. Those are issues that we need to grapple with. But the reality is IT is affected, and we cannot run away from that.
Okay. Jakes, I go back to that question again, which is that what you flagged off right at the beginning, that look, this is the ceiling which has been indicated by the US administration. Bilateral negotiations will start, diplomacy will start. By the time the real tariff is implemented, it could be 3 months, it could be 3 weeks. So can I say that from a market standpoint now, the room of disappointment is over and the headroom for surprise opens up, because whatever the negotiations would be, the negotiations would be much lower than what the current projected ceiling rates are.
No question about that.
Okay. So Jakes, from an market... Yeah, no, Jakes, I thought you just made your point. So yeah, let's take that point forward.
No, I'm saying that the worst case from a market's perspective has played out. In terms of markets know the number or know the what it could do. I still don't know if the relative landscape has played out fully. The problem has always been China. The problem will remain China. And there it's not just tactical negotiations. There's a lot of ego involved in it. There are personalities involved in it. And there are hard, real issues that China is facing in terms of where to hold their reserves, etc. Bilateral trade, etc. is another issue that China will bring about with other countries. So I think the world trade order has been redefined for some time to come. Bilateral trade blocks will emerge. And I think that is what the opportunities will be, that well, the US will be one partner, but the world will get used to regional blocks, regional trade tariffs, and bilateral packages with a lot of people. So from that perspective, the world trade order has changed completely. And I think, I hate to say, but I think the US has come out significantly worse. And, when you look back and see what this has or attempted to achieve, whether in terms of, hard, modern day, non-traditional economics or otherwise, I mean, this is a series of very, very illogical steps. And, negotiations have been taken to a new stratospheric, level which lacks any finesse or otherwise. But the reality of the numbers will still take maybe a week to play out. Numbers will be lower than this. How much has India benefited vis-a-vis its other competitors? That I think the days will tell us. But we should be at the lower end of a lot of the numbers that finally emerge, and therefore, from a competitiveness standpoint, also maybe this will become a blessing in disguise, that we've got this unintended sort of benefit of relatively lower tariffs compared to the others.
I'll just take a moment to first talk about where we were, let's say, in the month of Jan and Feb. Dollar was strengthening, that has reversed. FIs were selling, thankfully that has got stalled. Macros were under pressure, thankfully they are improving. Valuations were stretched, froth is out. Tariffs were a concern, clarity has emerged. So bottom line is, Jakes, teji karne ka, right?
I have been bullish, and I think the markets ultimately find their own levels. And they did find their levels, almost 2-3 weeks ago when they bottomed out at just under 22, I think 21,900 or whatever. And they keep looking for excuses for corrections to shake out people and participants. But as we sit and look at the markets today, I'd be very, very keen to deploy whatever surpluses I have.
Jakes, other than banks and financials where there's valuation comfort as well and seems like pretty much a consensus call, any other sectors which are looking interesting right now? Would pharma make it to your list, given that pharma has been exempted from tariffs?
Pharma has always been on my list, and while I say there may be consensus, but have people participated adequately enough to be fully owned? I think that's the question. So people may say from a trading perspective, people have moved money here. But I think these are the sectors, whether it's banking and financial services or pharma. I think these two sectors, and to an extent, because the commodity cycle will get stoked with a very sharply lower dollar is my take. And as the dollar continues to weaken, the commodity cycle will play out as well. So commodities, pharma, and banking and financial services will be the top three picks from my perspective.
To have you, Jakes, on the show. And by the way, the pre-open rates are indicating that it's going to be a less than 1% fall for the Nifty. So I think the Q is right in there. That's where...
If you like this video, then like, share and subscribe to ET Now.